Hello and welcome to another technical analysis video tutorial. In this tutorial, we're looking at the RSI, the Relative Strength Index, and that is one of the most popular indicators people use in trading or investing or generally when doing technical analysis. So before we start, let's activate the RSI here in TradingView. By the way, I'm on the daily chart here. So I have to go to indicators and strategies. I type in the RSI, Relative Strength Index, have to activate it, and there it is. Right, so let's explain the RSI. What is the RSI? The RSI in brief, it's a momentum indicator. Again, it's only an indicator, so only using the RSI to determine where the market might be going, or a sort of entry position or exit position of your trade is not recommended because it is only one indicator, and I personally use several indicators, at least two, ideally three, when looking at a chart and when determining where the price might be heading or when making decisions. So only using one indicator is difficult. Also, again, it's only an indicator, so it indicates something, doesn't necessarily need to be correct all the time, doesn't need to work all the time, but it's an important and very popular indicator that many people are using. So the RSI is looking at the last 14 periods. So looking here, basically the last 14 candles. So the last 14 days on the daily chart. It would be different on a different time frame. On the weekly, you would have the last 14 weeks. And it looks at the momentum change in price. So it sets into correlation the average upward move in price and the average downward move in price in that given period. And the calculation is a little bit more complex, but without showing tons of examples, it's very hard to explain, and it's not strictly necessary to really understand it, but it's important to understand that it shows the momentum change of the price, and it's also looking at roughly, how many green candles there are, how many red candles there are in the last 14 periods, and also the strength of these candles. And before we go further into this, let's take a look at the RSI, because there are three levels here. The lowest one is the 30, middle one is the 50, and the top one is the 70. Generally, a market is considered to be in a bull market, in an upward trend when the RSI is above 50. And it's considered to be in a bearish market when it's below 50. When it's below 30, it's considered to be in an oversold area, and many people use that as an entry through, for example, for a start of a long position. As you can clearly see down here, there was a tipping point when that 30 level was hit, and after that the price went up as well and the RSI went up as well, but it was really that lowest point here. So the 30 really also on the RSI, you could say, acted as a resistance level. Sometimes the 50 level acts as support as well. It's quite interesting to see that actually 1, 2, 3, 4 times here, various other times as well, and sometimes it acts as support level. So that's interesting. When it is above 70, it's considered overbought. So oftentimes when something is in the overbought range, it is generally not recommended to buy, but this is again not always the case, depending on what kind of commodity, crypto security or whatever you're looking at. And if it is very volatile, it could be that is for a longer period in the overbought area. So for example, some people adjust it actually to 80, right? That line here. If it is a very volatile product or commodity that you're actually trading, that you're looking at. So you can change these levels, but generally in a bullish market, it's generally trading between 60 and 90, you could say, with the 50-60 range as resistance, and in a bearish market, trading, between, maybe 10 to 50, and again the 50 is then the bullish, the resistance line. That's as far as the different levels are concerned. So let's maybe take a look at a few quick examples. So we can see clearly at that point here where the price really gained in momentum, you can clearly see that upward move, the RSI went up as well, right? So that's an important indicator. Yeah, so basically that means that in a bullish market, for example, the price increase is confirmed by the RSI. So that is very bullish, that is clearly uptrending. What we can see here is that even though the price was still moving up, the upward move was less steep, top to top. It was harder for the price to make new highs. And basically what you can see on the RSI, that price increase was not actually confirmed anymore on the RSI. So people call that a divergence. It's also called a bearish divergence, because while the price was moving up, the RSI was going down, which is meaning that while the price is going up and we are still in bullish territory here on the RSI, it's still bearish because it is losing momentum. You can clearly see that the RSI is losing momentum, the RSI is going down. Whenever that is the case, it's called a bearish divergence, and it can indicate that a probably a sideways move or even a move to the downside could be happening. Let's carry on. So we're here in a sideways move, which is confirmed by the RSI as well. And then we have the price drop that is confirmed as well by the RSI. So downtrend, clear downtrend. And what we can see here is an upward trend, also confirmed by the RSI. Downtrend confirmed by the RSI. And pretty much these downtrends here were confirmed also by the RSI. And again, price going up here, also confirmed by the RSI. What we can then see here at the top, and I just have to adjust this a little bit, at the top here where we are currently, you can see that it's losing momentum again, because while the price is going up and this is all looking good, the RSI is again making a divergence, and this is again a bearish divergence on the RSI, indicating that potentially a correction could be coming also. But you need to remember, when that started over here, for example, it took a while. It actually took a month nearly for this to take place, for a correction to take place. But you can also see that whenever that took place, there was increased volatility compared to periods where the price was just trending up. Less volatility, really less up and downs. The price was moving clearly in one direction, and the RSI was confirming that. But whenever you have this divergence, you oftentimes see a lot of volatility, a lot of green and red candles. So looking at that, it is normally very, very helpful to use the RSI in a trending market. So when you use it here in a sideways move like that, where we had between March and April, the price was really moving sideways, and then the RSI isn't very, very helpful, but it is very helpful to identify these swing points, these upcoming moves. So clearly here, if we go back just to this area here, this time period when we really had the price moving up and the RSI was confirming that, and it was converging, so doing the same thing, that is a good thing. That basically confirms we are really in a strong uptrend. But whenever you then have these divergences suddenly coming up, and you typically only see that in trending markets, so not a sideways move, but a trending market. So when they are not doing the same thing, that should really pick up your attention, because you can clearly see we were going up here as well, very steep, and the RSI was going up as well. And suddenly you can really see that there could be something coming, because the RSI is dropping, and then eventually the RSI started very early to drop, but you can then eventually see that we were moving in this sideways move. And also let's take a quick look if we can make out anything here. This was actually all confirmed because this was a rapid price increase. See if we can find another divergence, maybe from the other end. Price, no, this was actually all pretty much confirmed. It's only here then where we currently are that you can see the same thing, price going up and the RSI doing actually something else. So this is what really should pick your attention. But I said before that the RSI is obviously only one indicator, so you can use it together with other indicators that we already spoke about or will speak about in a few other videos, like for example support and trend lines. So let's say you have a support line somewhere, like for example currently. So if we go back up there, and we can clearly see that we did hit that level before, so if we just have a line here, so we have a clear resistance line here, and if we say we have a resistance there, plus we are currently losing momentum, we've been losing momentum already here, then it could be a sign that we should be getting ready potentially for a reversal. So always take roughly 2 or 3 indicators together to come to your conclusions. Don't use only the RSI, don't only use bearish divergence, but if you have a resistance level here, can't get through, losing momentum at the same time, and maybe moving averages crossing to the downside as well, that could give you some indication that there is a move to the downside to be expected. So what I'm doing when I'm trading this, and I, for example, would buy here at the lowest point, I try to stay in the market as long as I can, until there is a shift in momentum. So for example, at this point, and you really see a shift in momentum while the price is still going up, but basically the momentum is going down because it's harder for the price to make new highs, then it might be time to, for example, sell and close the position. So I've now added moving averages as well, and just to take a look again at this example here, where we've got this bearish divergence, that's why I like to use both the moving averages as well as the RSI together. So basically two different kinds of indicators together, just to avoid any false assumptions. So what you can see here, uptrending market, bearish divergence, and then you take the moving averages and you have already the 50 and the 20-day moving average here very close together. We can see that the 20-day moving average is actually support here. I mean, it failed for a short period, for a few days, but then again, we moved up again and sort of always had this as support. And if the 20-day moving average failed, we still had the 50-day moving average as support. I think this is just to prepare someone, and for me, this still shows, for example, in this particular example, that we did not enter a real downtrend because we were still trading above the 50-day moving average and at times also above the 20-day moving average. And so while there is a bearish divergence and it could signal something coming, and it actually did signal that we moved into a sideways move, but if you want to be sure that you still stay in the trade, for example, and avoid that you sell even though we are still in a bullish market, then it is important to take into consideration the moving averages. And for example, it would have been different had we dropped below the 50-day moving average. And by the way, we did here for a short period of time, but again, that was only for a few days, and then we gained support again and started to move up. So it was a false breakout basically. But if you want to avoid that you sell your position because of just because of the RSI, you can still take the moving averages to be on the safe side, because this shows that we were all the time, only exception is this false breakout, above the moving averages. So still a bull market, still positive trend, and then you wouldn't have had to sell your positions, for example, and you made all of these gains if you stayed in the trade as long as possible. And maybe here then, even though that was of course still above the moving average, but then you could have taken shorter term moving average into consideration. But it just shows you how you can use both together, the RSI and the moving averages. So it gives you both a good indication of in which direction the market is heading. So I hope with these examples it made the use of the RSI more clearer, just to remain on the side of caution when there is a bearish divergence, and take into consideration the moving averages as well, to just have another indicator to get an understanding of, are we really breaking into a bear market now, for example, or are we still in a bull market? I mean, in this example here, we most of the time were above the 50 level anyway. So from an RSI point of view, we were pretty much all the time above the 50 line, above the in a bull market. And to be honest, the moving averages confirmed that. Only exception was then down here in that period here, where we really also traded below the moving averages, but then we also moved below 50. So this was a good indication here on the RSI as well. Below 50 and below the moving averages showed really a small bear market, and even the moving average here acted as resistance level then. So this is how I use the RSI and the moving averages together. I hope that made it a little bit clearer. Let me know if you have any other questions. Hope you liked the video. If you did, please smash the like button. And if you want to follow me on this journey, then please subscribe. Thanks a lot for watching, and see you in the next video. Bye.